welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, a lot of us aim to accumulate a corpus of 1 crore rupees in our kitty for our retired life. Certainly, it's a huge amount to have, but is it really enough? Is it enough to generate a sufficient income for our retired years? And how much should you accumulate every month? How much should you invest every month to be able to generate that corpus? Well, to get answers to all those questions and much more, watch today's episode.
It's very difficult, if not impossible, to guess, or to estimate how much you need in your retirement. If you're 35 years away from your retirement, it becomes extremely difficult. If you're 10 years away from your retirement, then maybe, you can estimate or have a reasonable estimation of what you're likely to need. Just keep in mind few things. One is that what are the changes in your lifestyle which will impact your expenses and income, and how much of it, your living cost will change in 10 years time, 15 years time. So that is one crucial input. But more importantly, err on the side of caution. Have extra buffer. A good starting point will be, looking at what is your monthly expenses and adjusting it for the inflation for the coming years. If you need 50,000 rupees a month, then imagine that you need 6 lakh rupees a year. 6 lakh rupees a year, and next year you need another 5-6% more. So that is the kind of income requirement that you have. Depending on how many years you are away from your retirement, you have to plan for that. So whether you are 30 years, 35 years or 20 years, so go to Value Research online, look at the goal calculator, adjust it for the inflation, you will be able to get an estimate of that. But more importantly, today's expenses will also undergo a radical change. Today you might have a set of expenses, and 20 years from now or in retirement, your expense configuration will change. That will change depending on how many dependents you have, how many financial dependents you might have, and what is your health condition. Based on these, I think have a margin of safety in a way that assuming that you need 1.5 crore or 1 crore rupee to support an income today, that is the amount that you should target. But simply adjust it by 25% more for all the kind of contingency. And you should do it only when you have the time. Because when you're 25, 30, 35 years away from your retirement, you can plan for it and you can do something about it. When you get closer to your retirement, your options will be closed. 1 crore looks like a very nice round number, 7 zeros after 1. And it used to be a very handsome number, but it used to be a handsome number when I was a child or when I was, growing up, not any longer. And maybe, it is still fanciful to be, winning Kaun Banega Crorepati. So in that sense, it might be meaningful, but it may not be. Think in terms of what is your likely requirement. If your likely requirement is, something like 40,000-50,000 rupees a month, which means something like 5 lakh rupee or 6 lakh rupees per annum. If you have 1 crore and you earn 6%, that might look like a handsome return, given that it will be, I'm referring to 6% as post-tax. That will translate into a return of something like earning of 50,000 rupees a month, which might, if it is good enough for you, it's fine, but that may not be good enough, because you need some margin of safety, margin of error. There will be, if you are generating 6% post-tax, which means you have to earn something like 7.8%. 7.8% or, maybe 8%. And 8% and you pay taxes, you will be left with the 6%. And if this is going to be good enough, how do you earn 8% in a predictable manner, in a guaranteed manner? There are no avenues which will produce 8%. And then this is half the story. If you consume all the money generated post-tax, then your capital remains constant, which means that you need to generate so much more so that your capital grows to an extent that it can protect the value, because 1 crore today is not equal to 1 crore next year and is not equal to 1 crore 3 years from now. And going by this situation, your 1 crore remains constant if you earn 8%. Which means that you have to work towards generating something like 10-12%, so that a part of the money which you will consume, a part of the money which will remain as your investment, and it will support a higher income in future. And with that in mind, I think anything less than 10% is risky. Return of 12% is desirable, and maybe little more return to have that cushion, have that safety. Which means if you need 50,000 rupees a month, 1 crore may not be enough. If you are faced with a bad market, then you need to have little more than that. And also many other situations, many other things will actually contribute to it. Your health situation, your healthcare cost, and other person's situation which might warrant a higher expense or higher emergency need. So you need to really prepare for much more, have a greater safety with a higher margin of error. A good starting point will be what your current living expense is, and inflate it by something like 6% or 7%, maybe higher. And living expense adjusted for inflation is what you require at a future date. And then you go to Value Research Online, look at your goal planner. There is a tool which will help you estimate an assumption of 10-12% return, and that is reasonable as of now. It might change over a period of time. That may change in future depending on the prevailing interest rate, the prevailing rate of inflation, and which will also impact the rate of return on equity as well. That is a good starting point, and it could be any sum, but that is very much in line with what you are earning and what your living expenses are. And if you want a dramatically different lifestyle or expense requirement, which is completely different from what you are spending right now. For example, if your current living expense is something like 30,000 rupee, and you think that in your retirement you aspire to actually have a lakh of rupees a month, then you need to plan for it. But unless a good starting point will be inflating your current expenses, current income requirement to the year of retirement. There is a simple course of investment for your retirement. One is that you should be as much in equity as you are far off. So when you are starting, when you have all the time, when you are 30, 35, 40 years away from your retirement, when you are starting with your career, start early, whatever small amount, but be very regular with it. Be disciplined about it, and be fully invested in equity even for the initial years, because you don't have to worry about anything. You don't have to worry about asset allocation. You don't have to worry about a big fall in the market because you have nothing invested. What will fall, and you are just beginning. The second important rule which you should follow is that most of us think in terms of constant, that okay, I'm doing my 5,000 rupees a month or 6,000 rupees a month. That's not the way of looking at it. That's not the right way of looking at it. Things don't work in a very nice linear fashion. Increase your investment with rise in your income, and be extremely disciplined about it, because in the initial phase of your career, I think the first 5 years is just about forming the habit. Money is not important. Forming the habit is extremely important, because if you don't start then, you will never continue and follow up in future. If your income is growing by 10-15%, increase your investment as well by 10-15%. You have to worry about your retirement corpus only in the last 5 years before you retire. You have to think about it. And this should be the formula till you approach your retirement 5 years before that. Invest as much as you can, invest as much in equity as you can, and resist your temptation to draw money from your retirement corpus for something which looks tempting, and you'll be drawn to it, expensive holiday, and you don't have the money, but you think that okay, let me take this money out because retirement is still far off. Never do that, because it will come to bite you later. If you consume that money, your future will be at risk. So you keep this thought in mind. You have to really do something when you approach your retirement 5 years before that. Start taking out small amount of money. The money that you need in the first year of your retirement, you should have it 5 years before you retire in a debt fund. The money that you need in the second year of your retirement, you should have it 4 years before. You should take that money out. So, have your 5-year plan before you retire. So once you have that preparedness, you will be very sure you don't have to worry much, because your money can remain in equity. You will have 5 years money lying in fixed income on the day you retire. and you'll be completely assured, and you can just mount a systematic withdrawal plan from the fixed income investments. So you will derive the mental comfort that you don't have to worry about where to draw your money from in retirement. To help you figure out how much money you need in your retirement and will that be enough to support your income, you have the goal calculator and you have the savings calculator at Value Research Online. So use that to do your scribbling in terms of how do you go about doing it. The variation of the goal calculator also takes into account how much will be the step up investment that you require, because our investments don't happen in a linear fashion. Today you might be able to save 5,000 rupees. 5 years from now you might be able to save easily without much of a great difficulty 10,000 rupees. So it can actually factor that in. How do you go about investing that money to grow it well, grow it in a safe manner, grow it steadily? Use our portfolio planner, and that will give you a very specific direction in terms of where to invest and what to look forward to.
With that, it's a wrap. Thanks for watching. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.